Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, one man's collapse, another man's correction. We look at what's in store for real estate as fears of a global recession grow. Also this week, why millions of homeowners in the Eurozone and beyond are highly exposed to rate rises during any economic downturn. Plus, we ask a property investor where he sees the market heading in 2023 and what homeowners can do to protect themselves. Is the global housing market heading for a painful downturn? Things were looking peachy for the sector at the end of 2021. House prices across countries in the OECD were growing at their fastest pace for 50 years. And all of this was underpinned by low borrowing costs and savers with money to burn. Now, just over a year later, things are not looking so rosy. High inflation has led to central banks hiking their base rates. Wages aren't keeping up with the rising cost of living, and the economic repercussions from the war in Ukraine will be felt for some time to come. Well, joining us now to discuss all of this is Andrew Baum. Andrew is an emeritus professor of practice at the Said Business School, University of Oxford. He's also the chairman of Newcore Capital Management. Good to have you with us, Andrew. Talk us through the bigger picture here, the macroeconomic situation underpinning the housing market right now, as it looks like, about to enter a global recession.
Yeah, I think the big news, Adrian, about the housing market is most people would say it's rising interest rates and the fact that they are now back to higher levels that we saw last in about 2007. So if you recall, the global financial crisis led to a massive cut in interest rates from, in the UK, 5.25 to about 1.5 by 2009. And then they've sort of come down again because of COVID. So we've got used to this really low interest rate environment, and that's all reversed in the last 6 to 8 months. And that reversal has caused people to assume that we've got a housing problem because of the rising cost of debt finance. So that's clearly a big issue, and that's creating a lot of concerns in the housing markets globally right now. So that's the big news. And there are lots of other little things that we also need to be aware of. So the tendency of governments to regulate, to protect tenants is one thing. The ESG is another. So environmental concerns and what we do about insulating houses, that's another concern. And then just the general lack of homes, the homelessness problem, the fact that in the UK, we think we've got a shortage of 3 million homes or so. All of that is a problem as well. So when you put everything together, housing is clearly an issue which is at the top of a lot of people's concerns right now.
Andrew, are we heading for a global recession? And is the era of cheap money well and truly over?
Well, I think the era of cheap money is well and truly over. I think that's a sort of an easier question to answer than the second one. I learned a couple of years ago that making forecasts is dangerous. So we all have our opinions. But yes, the era of cheap money is probably over. I think we've been through a very, very unusual period from 2009 to 2022, when we had abnormally low interest rates, and we've all gorged on those very low interest rates. We've been able to borrow money at incredibly low prices, and people like me with grey hair have been expecting some sort of reversal in interest rates for quite a long time, and we've actually been over forecasting that. It's taken a lot longer to reverse than we expected. The arguments in favour of global recession, I think the UK is almost certainly in recession right now, or heading for a slowdown next year. That's partly because of massive increases in commodity prices, heating bills. So we've got a problem. We've also got a budget that is squeezing money out of the economy rather than putting it back into the economy, which is what you'd be hoping to do in a time of weakness. So we've got a double hit, and all countries are being affected by rising costs and huge inflation. And the reaction of most governments to huge inflation is to rise interest rate, increase interest rates, to try and squeeze inflation out of the system. And the price of that is often a slowdown or a recession.
You say that all countries are experiencing this, but are there any particular markets around the world when it comes to housing that will feel the pain more than others?
Well, some markets are characterized by hotter money than others. So there are some international markets where there are flows of capital, which can be good and can be bad. If you've got a market where people speculate, for example, then you get hotter money flowing in and out. And where you've got speculation, you're more likely to get rapid changes in prices. Against that, so that would include markets like New Zealand, Australia, the US, the UK. I think the US is probably the best example of that, where people will speculate on houses, buy 3 or 4 if they can afford it. Against all of that, though, you've got fundamental undersupply of housing in some markets, the UK being an example. So the UK is confusing because you've got a big undersupply of housing and you've got the possibility of hot money flowing in and out. Another confusing point, of course, is the weakness of some currencies. So if the pound is weak, then overseas buyers will find house prices more attractive than domestic buyers. So you've got quite a few issues that are banged together to create some sort of view about whether you're going to get price falls or not. And generally speaking, house prices don't fall very quickly. Only when you've got a really speculative market. And the US is probably the best example of that.
Let's talk about the US in particular then. Are we set for a house price correction in the US? Is that going to cause further damage to the economy there? I mean, let's not forget that the financial crash 12, 13 years ago began in the US due to bad home loans.
Yeah, I mean, yes. I mean, I think the house price correction has already started in the US, and house prices will almost certainly be lower in a year's time than they are now in the US. And you can read this 2 ways. You can say that is going to lead to a slowdown because people feel less wealthy. Some people are forced to sell their houses. Some people then lose equity, they lose capital, they're less likely to spend money. You then get some sort of slowdown. But there's another way of looking at it, and that is that cheaper house prices are good for a lot of people. A lot of people would say that house prices have become too high, that the speculative element in house prices needs to be squeezed out of the system, that higher interest rates aren't a bad thing if you can finance your house purchase when they settle down at lower house prices. So I'm not completely sure that low house prices lead to a recession. I think it can work both ways.
Right, but what about the Federal Reserve? How can policymakers bring down inflation without hurting homeowners in the US and triggering more foreclosures?
Yeah, well, very difficult. I mean, the good news about the US is that a lot of mortgage interest is fixed. So the majority of borrowers will have fixed their mortgage rates at low interest rates, the vast majority. So anybody who financed their debt before 2021 will have financed at very low interest rates, and they're not going to be affected by the increase in rates. It's only if in markets where you've got variable rate mortgage financing that you're going to see a bit of stress. And even the UK is moving more towards fixed rate finance. So there's going to be a number of very unfortunate people who are forced to borrow money at historically high interest rates. But the vast majority of borrowers have already fixed their finance at lower rates.
It's been really good to talk to you, Andrew, on Counting the Cost. Many thanks indeed for being with us. Andrew Bourne.
Thank you.
Now let's take a look at how people fund their homes around the world. Not all of them share the same exposure to risk during any global economic downturn. In the US, for example, mortgage rates tend to be fixed for 2 or 3 decades, so the pain from rate rises can often be delayed for owners. In contrast, in Australia, around 80% of mortgages are tied to variable rates. Homeowners there are the most exposed to higher rates in the world. In Sweden, it's seeing a reverse in its housing boom because of energy costs and higher rates. There, many take on interest-only loans that don't require paying off the principal loan. Finland's mortgage market, however, is almost entirely priced at floating rates. But those who live in the south of Europe tend to live in mortgage-free households where inheritance or family support is a common route to ownership. And Germans are more likely to rent than own their homes, so rate rises will have less of a direct impact on them. Well, for more on the Nordic perspective on home buying, we're joined by Arje Aust, who's a professor in financial economics at NTNU Business School, and he's in Oslo in Norway. Good to have you with us, Arje. Talk us through why people living in Scandinavia often go for these interest-only mortgages rather than fixed or variable.
So the reason why that is partially cultural, partly historical, and partially because of difference in regulation. So there are, and of course, when it comes to cultural, we have a great deal of security nets in the welfare states in the Nordic countries. So you are supported in a lot of ways. So it's not feels so risky. And secondly, we tell them that this is insurance. So it's beneficial for them to have floating interest rates and not fixed interest rates. And lately, the last one is regulations. They have positive effects for the households, so they don't get extra mortgage, for example, by choosing fixed interest rates.
But if people have interest-only mortgages, they're never actually going to pay off the full loan on the property. Therefore, presuming if they want to end up owning the property in which they live, they have to have another vehicle which is going to pay off the principal sum.
So what we typically have is that, it's interest only for just a limited time period, for example, 5 years, and then they start to pay down payments.
So it's not interest only for the whole term?
No. So it's typically in a limited period, typically when you are young households who is just entering the market. And then after a while, when typically their wages are increasing, then they're starting to pay down payment on the loans.
Okay, Sweden at the moment is seeing a reverse in its housing boom. Explain for us why that's happening.
So in Sweden, we have a huge boom first, especially under Corona, where the interest rates become negative, actually. And then you got a huge boom, and then now we got a bust. So it's extremely hard, actually, and it's partly, of course, caused by higher interest rates and partly by inflation. So in Sweden, we have 10% inflation, so that hits consumers quite hard. And so they have less money to spend on housing.
And what about in Finland? Mortgages there are almost entirely on a floating interest rate, a variable rate. So we could assume that homeowners there face more risk from rising interest rates than perhaps elsewhere in the Eurozone.
Yeah, so in Finland, they didn't have this boom cycle. So the prices is actually quite low compared to Sweden and Norway. So they are on a low level. So the interest rates shouldn't hit them as hard because they are not that much in debt. So yes, they have floating interest rates as we have in Norway as well. But because the dwellings is cheaper, it doesn't harm them as much because we didn't have this boom period at the same level as in Norway and Sweden.
And what is the situation in Norway at the moment, the property market? What's happening there in Norway?
So in Norway, we have starting to see a decline in house prices, not as severe as in Sweden. So the fall has been more limited, but we're starting to see something. And it's very exciting or interesting to see what will happen in January and February. Typically very strong markets in Norway. If we will see a fall in those 2 months, it will probably continue.
And one thing we haven't talked about is the rental market across the Scandinavian countries. How many people are renting there?
So it's very different between the countries. So in Norway and Sweden, it's quite a limited number of households that is renting. So 20% in Norway and a little bit more in Finland. In Sweden and Denmark, we have regulated rental markets and a high share of the households who is renting.
And one of the things, Arya, that we hear about the UK in particular is that there are entrepreneurs who look at buying property as a sound investment. There's the buy-to-let market. Does that exist in Scandinavia?
Yeah, so it exists the rent for buy, but it's just starting up. So we will see what if that will become popular. But it has been used like a foothold for young households to enter the market. But it has just started, so we will see. Maybe the increased rents will push that forward and increase that size of the market.
Professor, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us. Arje Oost there in Oslo.
Thank you for having me.
Now, in the UK, the economy shrank for a fourth consecutive month in November, pointing to a deepening recession that's expected to last more than a year. Mortgage repossessions that month also soared by more than 90% on the year before as the cost of living crisis bites. So, where does all of this leave people who have mortgages? Well, someone who's written extensively on this subject is Rob Dix. He's a property investor, author, and co-founder of Property Hub. He joins us now from London. Rob, good to have you with us. What are you seeing in the property market, specifically there in the UK right now?
Well, it's been cooling significantly, not just since the mini budget, but that did kick it up a gear. But we were talking about this back in sort of that June, July kind of time. The market cooling right off, but interestingly, it's not as bad as sentiment would have you think. So if you look at the actual data, if you look at the number of properties having price cuts, if you look at sort of buyer interest and things like that, it's fallen right down, but it's only come back to where it was in a normal year, kind of before the COVID sort of sent the market into overdrive. That's not to say it won't get worse from here. It could do. But it feels like at the moment, the sentiment is worse than the reality on the ground. And the flip side of that is that the rental market at the moment is super strong.
Yeah, the Bank of England, though, is saying that it might have to raise rates again, at least a couple more times. I mean, how long is this I know you say that things aren't as bad as perhaps the sentiment would lead us to believe, but how long do you think this pain is going to go on?
I think the Bank of England is almost certain, well, it is going to raise rates from where they are now. But after the last rate hike up to where they are now, they did signal quite strongly that they wouldn't be raising rates as far as markets had priced in. And I think that's interesting because they sort of went through a period of talking very tough about rates. And now it's almost like they're almost nervous about what it's going to do to the market, housing in particular. And they're trying to talk it back down again. It all comes down to the path of inflation, which is really hard to predict. My personal view is that inflation will start to come under control in the next 6 months or so, and that's going to make the Bank of England's job significantly easier. And they're not going to want to raise rates any further than they have to. But of course, it is going to be upwards from here. So I don't think anyone's going to look back at the end of 2023 and go, what a great year this was. But I do think it's going to feel better than it does right now.
Nonetheless, Rob, I mean, even if rates don't go up as much as perhaps we're expecting, even a small rate rise can have a significant impact upon homeowners and the amount that they have to pay to mortgage companies. For anyone who isn't on a fixed rate right now, what can homeowners do to protect themselves?
I think we've seen over the last month that the mortgage market has started to significantly improve. We've seen rates coming down over the last month, and we've seen more product choice. Lots of lenders pulled their products off the market around about September, October, because so much was going on, and now they're starting to come back again. So I think if you've got the option of doing nothing and just waiting, that's probably a pretty good move, because I do think things will improve from where they are now. If you're in a position where you have to do something because you've got a rate that's come onto an end and you've gone to a really nasty variable rate, then it's really important to work with a good mortgage broker who can show you what their options are. Because there are things you can do, such as going onto a variable rate with no penalty for sort of switching to a fixed rate, which means you can get a rate that's better than you've got now and then come onto a fix when fixes come to a price that you're happy with. So there are things you can do. But I think if you're a homeowner who's on a rate, you've got a fix that's got a few years to run, but you fixed at, say, like 2% or something like that, which is pretty realistic about a year ago, you need to be prepared that when that rate comes to an end, you're not going to be going back onto 2% rates again. It's going to be a long time until we see that again. So it's a good time to be preparing for what rates are likely to be in the future. So if you are in a position to have time to do that, that's great, but it's still going to come at some point.
Rob, where does all of this fit into the 18-year cycle? Perhaps you'd like to explain what exactly that the 18-year cycle is.
Yeah, the cycle, it's a theory. It was come up with by someone called Fred Harrison, who sort of went back and looked at data going back for about 200 years and found that real estate tends to, or land values more accurately, sort of tends to move in this pattern where on average you sort of have an 18-year cycle of boom and bust. So prices sort of rise steadily for the most part. They then have a couple of years where they rise really sharply and then they crash again. Now the 18-year part is an average, and so it's not something you can sort of set your calendar by and decide when you should be buying and selling property, but it is got an indicator that's been useful. So we used it to sort of correctly predict that prices wouldn't fall in the wake of Brexit and COVID, which wasn't consensus at the time. So the cycle, if you're sort of following the 18 years, is currently sort of meant to end in 2026. So according to that, there's another few years to go. So as an investor, that's interesting. There are things you can do. It allows you to actually capitalize from the strong growth at the end of the cycle when everyone thinks that the cycle's come to an end already. As a homeowner, though, it's not something that I worry about too much, because you buy a home because you want to live there. So it's not a good idea to try to time the market in that respect. The real key is to be able to make sure you can afford your repayments, because what the cycle shows us is that, yes, prices crash, but the long-term trend is always up. So the real key is to make sure that you're not forced to sell at one of those times when prices have fallen, because if you do just keep on holding, then eventually they'll come back to where it was and beyond.
Rob, you've written about how pro-interest-only mortgages you are. It's something we were talking about a few minutes ago, where they're incredibly popular in Sweden. Of course, if you want to end up owning the home, at the end of it, you've got to have another vehicle to pay off the principal. Given the global recession fears and everything that's happening in the UK right now, has your stance on interest-only mortgages changed? If not, why not?
I think it's very different for homeowners and investors. Because if you're a homeowner, most people will just want to have that home paid off, in most cases as soon as you can. So in that respect, just having a fixed payment where you know if you make that payment for the right number of years, that you then own the property free and clear, that's what most people are going to want to be able to do. And it's quite difficult to get a interest-only mortgage on a residential property anyway. For investors, I think it's different. For investors, I think the reason that I say interest only is better is that it gives you flexibility. It's not that you won't want to pay off chunks of your mortgage. You can pay off chunks of your mortgage whenever you want to, but you're not locked into that repayment schedule. So as long as you keep paying the interest, you then have higher cash flow because you're not paying the principal off, and you can decide when you want to pay it off. You can decide which of your properties you want to target to make payments to. So it's really about flexibility. So nothing about the current situation changes my view on that when it comes to investors. But that's completely different for owner-occupiers. There will be some owner-occupiers who feel the same way, but in the majority of cases, they're just going to want to pay it off, and that makes a lot of sense.
You mentioned how buoyant the rental market is at the moment. I mean, there are two ways of looking at this. People who rent are being faced with increases in the rent right now, but investors are finding that it's pretty good. Would you invest in a property right now? If so, why and where?
Yeah, I am investing right now. I think I've got two going through at the moment, both in the Midlands in the UK. And the reason for that is I'm investing for the next 20 years plus. So I'm not that bothered about what happens in the next couple of years. If prices fall, doesn't really matter, because as we talked about with the property cycle, the long-term trend is always upwards. So that doesn't bother me. And as an investor, rents are particularly strong right now, which is helpful, but rents tend to be very, very steady. So even when house prices fall, we saw it in 2008, rents stay steady and sometimes even rise a bit because there are more people wanting to rent. So you've got your rental income, which is very steady and very secure. Then that will kind of persist for many, many years. But then the actual prices will move all over the place. Sometimes they'll be up, sometimes they'll be down. But if you're investing for long enough, then you can not be too concerned about what happens month to month, year to year.
Rob, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
Thank you.
And that's our show for this week. If you'd like to comment on anything that you've seen, you can tweet me. I'm at @afinnegan on Twitter. Please use the hashtag AJCTC when you do, or you can drop us a line. Counting the Cost at aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and entire episodes to catch up on. But that is it for this edition of Counting the Cost. I'm Adrian Finnegan from the whole team here in Doha. Thanks for being with us. The news on Al Jazeera is next.